Today we're talking about the S&P 500's technical setup before the rate cut. And so we're recording this video on Tuesday, September 17th. So by the time many of you watch or listen to this, will already know what the decision was, and more importantly, the S&P 500's reaction to it. And so, of course, it's going to be more volatile than the action leading up to the cut. But what we care about more, again, is what happens after the fact. And many of the charts we'll go over today will be relevant regardless of what happens. So let's first talk about the range. And that range is between 5650 on the upside and 5400. These are all rough numbers, but we can tell here that it's really encompassed most of the price action going back to at least June, because June was the first time the S&P 500 eclipsed 5400 by gapping above it right here in the middle of the month, and then continuing all the way higher to just about 5650 or a little bit higher than that. Now, of course, at the time, we didn't know it was going to stop there. There wasn't any supply, of course, making new highs almost every day back then. But once we did see the market pull back from there, that's when resistance got discovered. We talk about support discovery a lot. It works the same on the way up. As the market tends to pull back from a key spot, we know that that's a level that eventually has to get back to. And considering the fact that we had such a strong run, really undisturbed from the middle of April, so 3 months worth of action, that has clearly been a very important point to get back above, which the S&P has been trying to do now over the last number of weeks. And so from the pullback from that point over the next 2 weeks, 5400 did hold. Now, it was short-term hold because as soon as August began, we saw the biggest 3-day decline of the year take place. And so we know that the pivot day on August 5th caused an emphatic reversal. And on the way back up, 5400 was recaptured very easily and really slingshot the market all the way back to, again, 5650, which it stayed near up until the end of the month. And of course, we know what happened since that point, back down to 5400. And then we have the massive positive reversal after CPI last Wednesday. And since that point, the market's rallied all the way back to 5650. Now, we know that early on Tuesday, the S&P did make a marginal new high, but considering how far we've come since last Wednesday's low, probably wasn't going to be in the cards to have an emphatic breakout before the news actually hits. And so another reason why is that on a short-term basis, if we look at this chart a lot, of course, the rally from the low produced another overbought reading on a short-term basis. We look at this on the 2-hour chart using the 14-period RSI, and we can see that just over the last few days, just barely grazed 70, but it lines up with what's happened numerous times since the low in October of last year. And the rally from the low got to about 5%, again, pretty much in line on average of the moves we've seen as well. So no surprises, again, to see a pause at some point. Market could go a little higher, a little lower, but we've seen this type of pendulum swing before, whether we're looking at it from a longer range basis, which we just talked about, going all the way back to July, or just on a multi-week basis, as we see sometimes on this short-term chart as well. Now, the other part is that the S&P ended Monday with a 6-day winning streak. And so that, of course, has been the longest streak since 8 in a row during that really strong comeback in August. And we saw 7 straight in July. Now, that's interesting because you think about what's happened over the last number of months. The market continued higher. We had not seen a streak longer than 5 going all the way back to January. And now all of a sudden we have 3 long streaks in 3 consecutive months, all of them stalling right near the same area. So again, we have the S&P getting back to the top of the range. It's short-term overbought, and we have a long winning streak in place, and really don't see streaks extend that much further than this. All of this taking place right before the Fed actually cuts rates. You can see how we're at potentially a standstill, at least for the short term, right? Until we see exactly how the market reacts to the news. And so there are supportive internals that have been taking place under the surface over the last 2 days. And one of the things is that the S&P finished Monday with 98 new 52-week highs. So we had a number of stocks, of course, get there before the S&P actually did. And so that is the most since 100 on July 16th, 2024, and that was the most since March 28th. Now, both of those dates probably ring a bell for all of us because those were key trading highs in March and in July. So, of course, the naysayers, the bears will say, well, here we go again. As soon as all the stocks catch up and make new highs, it's time to roll over. That definitely could be the case, but let's not forget what happened before that, right? It took a long time to get this, right? 4 months, where the first time we saw over 100 S&P 500 names make new 52-week highs from the low was in mid-December, and of course, we had a lot more to go from that point. In reality, you want a foundation, and considering the fact that you'd have a number of names making new highs when so many technology names have not, that is a recipe that will take any time. And we also saw this from a breadth perspective, looking at the S&P 500 cumulative advanced decline line versus the S&P 500. Now, this is a line chart, so it just captures the closes, and of course, we haven't closed above that mid-July high just yet, so the differences are pretty clear here, where the S&P 500's advanced decline line has been making new highs over the last few days before the S&P 500. And again, that just talks to areas like financials, industrials, healthcare, the ones we've talked about in the past that have been leading, coming back and making new highs once again, in addition to, of course, utilities. And so not the areas you think would lead when the market makes new highs, but areas that you need to have lead if you want this substantial uptrend to continue as it has been happening. And we know it's really been handing over the baton of leadership from technology to technology back and forth, which is getting us to this point. And now with many of the technology names, ETFs, indices that we follow, noticeably below their highs, you believe that a bid needs to come back into, the entire market for things to continue higher, but we can't do it without the other sectors. That's an important part there. And so a recent study we were talking about to our premium clients is that, we've had big weekly moves. And we know that last week with the market up 4%, it was the biggest weekly gain of 2024, but not by much, because as you recall, just a few weeks ago, as we're coming back from that August low, the S&P was up 3.9%. And so these are all of the moves of at least 3.9% on a weekly basis, going back to the COVID lows. As we know, they took place both during uptrends and during bear markets. We've seen them in clusters, and we've seen them in a vacuum back last October as well. So the question is, what does this really tell us with it happening near all-time highs? Is it a kind of a blow-off top like scenario, or is it an indication of more strength? Well, again, going back to the period we have listed here, the only other time that we saw this type of action occur near the highs was back in the end of, or toward the end of 2020. This is right after the election. And then the beginning stages of 2021, as we can tell from that point, as the market was making new highs, we still saw those big weekly moves, and that led to many months more of the market moving higher. So you can't just go by those two occasions, but it's also good to remember that just because you see a big weekly move for the first time in a while as a market makes new highs doesn't mean that is the reason that the market needs to then roll over. And again, we can point back to what happened back in late 2020, early 2021. And so let's end this with the pattern talk, of course, one of my favorite topics. And this is a chart that we showed a few weeks ago on September 3rd. As you recall, that was one of the biggest down days we've seen all year, happening as soon as we came back from Labor Day weekend, leading to a very rough start to September. But because of the ability of the market to rally so much, it could have formed a key higher low at that point. And we talked about how this was an upward sloping neckline of a potential inverse head and shoulders pattern. And we know things didn't play out according to plan here, which really not surprising, especially dealing with a pattern potentially this substantial. So this is how it looks now, where we've connected the highs recently, and again, we got that marginal breakout this morning that didn't hold. But in reality, it looks a little cleaner because we have a real higher low potentially here near 5,400. So the S&P was able to pull back more and hold. And again, the 5% rally from that point created this cup and handle like pattern. So the question is, what happens if we get a deeper sell-off right after the Fed cut? Is this pattern completely wrecked? Well, of course, it depends how severe that is. But initially, any pullback that takes place, say above 5,500, would keep this bigger pattern in play and could also create another smaller inverse head and shoulders pattern within the bigger one. And that's the type of scenario we always look for. This type of thing occurred numerous times along the way up as we got those 9 successful bullish patterns. Just want to see the ability of more patterns happening on top of each other. The more that work out, of course, the bigger the foundation that we have, and the more we can expect successful bullish patterns to play out, because that's really what's been happening all along the way. And of course, the last time we saw a big bullish pattern play out near all-time highs or at all-time highs here was in late May to June. We talked about this one before. Once we got that breakout in mid-June, again, through 5,400, that led to a lot more momentum coming back in and eventually getting to that last upside breakout target being acquired. And don't forget, all of this has been taking place above the much bigger breakout. The 6,100 target continues to be in play. Again, there's no timetable when that can be achieved. The best part of this whole thing is that because of the extension we had from that point over the ensuing few weeks to months, it's given the S&P the ability to back and fill, to endure the volatility that we've seen and create the opportunities for additional smaller bullish patterns to form on top of this one. And that's how something like this can continue. That's all we have for today. Don't forget to check out these videos and subscribe. I'll talk to you next time. Thank you.